Meta Platforms Incorporated, formerly known as Facebook, stands as one of the most iconic and influential companies of the digital age. Founded in 2004 by Mark Zuckerberg and a group of college friends, it started out as a social network for college students. Fast forward to today, and Meta is a $1+ trillion enterprise that connects billions of people worldwide, influences global communication, and shapes the digital economy. Its core family of apps, Facebook, Instagram, WhatsApp, and Messenger, are deeply embedded in our daily lives, while its ambitions now stretch far beyond social media into virtual reality, AI, and the metaverse. From an investor's perspective, Meta is a complex yet fascinating company. It combines traits of a tech growth stock, a media company, and a future-facing innovation lab. If you're watching this and considering whether Meta is the right stock for your portfolio, this deep dive will break down its key financials and performance metrics, while also offering personal insights and forward-looking analysis. Let's begin with the core numbers that define Meta's profitability and financial strength. First, earnings per share, EPS, is a critical metric for gauging how much profit the company makes per outstanding share. As of the most recent filings, Meta's EPS hovers around $17-18. That's a strong number, particularly given the tech sector's tendency to favor revenue growth over bottom-line profits. It indicates that Meta isn't just a hype stock, it's a real moneymaker. The P/E ratio, price to earnings, currently sits in the range of 22 to 28, depending on market fluctuations. That's lower than many high-growth tech peers, suggesting Meta might still be undervalued, especially when you consider the company's ongoing investments in AI and augmented reality. Meta is still very much in growth mode, but it's also profitable. That balance is rare and valuable. Meta's revenue has been nothing short of massive. In 2023, the company reported over $135 billion in revenue, driven largely by digital advertising across Facebook, Instagram, and increasingly Reels. While ad revenue is cyclical, Meta's broad user base, over 3 billion monthly active users, ensures a steady stream of demand from advertisers. Net income remains impressive as well. Meta consistently generates annual net income exceeding $30 billion, a testament to its high operating margins and business scalability. This isn't a company struggling to monetize, it's a business optimized for digital profits. Unlike some tech companies, dividend yield isn't a part of Meta's appeal, at least not yet. Meta does not pay a dividend, which is typical for a growth-oriented company. Instead, it reinvests profits into innovation, such as AI and the metaverse, which could lead to exponential returns over the long term. Now let's take a look at Meta's balance sheet. One of the biggest positives is its debt-to-equity ratio, which is incredibly low, around 0.1 or even lower. Meta essentially operates debt-free, relying on its massive cash flow rather than borrowing. That gives it incredible flexibility and resilience in volatile markets. The current ratio, which compares current assets to current liabilities, stands around 2.5. This means Meta has more than enough liquidity to meet short-term obligations. For context, a ratio over 1.0 is considered healthy. Meta's ratio shows that it's not only stable but comfortably so. Perhaps most importantly, free cash flow remains one of Meta's strongest metrics, regularly exceeding $20 billion per year. This allows Meta to fund acquisitions, invest in R&D, and buy back shares without compromising financial stability. It also means the company is equipped to weather downturns and reinvest in long-term vision. Even for a mature tech company, Meta's revenue growth continues to be solid. After a slight dip during the digital ad slowdown, the company rebounded strongly in 2023 with double-digit growth. New ad formats, AI-powered recommendations, and e-commerce integration, especially on Instagram, have helped reinvigorate top-line growth. Earnings growth has similarly rebounded, driven by both revenue recovery and cost-cutting measures, including layoffs and efficiency improvements. Meta has become leaner and more focused, particularly in its Reality Labs division, where it's streamlining efforts to build the metaverse. The company's market cap currently exceeds $1 trillion, making it one of the most valuable firms globally. This places it in the mega-cap tier alongside Apple, Microsoft, and Alphabet. Such market cap reflects investor confidence and long-term expectations, not just current performance. Looking at price-to-book ratio, PB, Meta trades at roughly 6 to 8 times its book value. While high, this is not out of line for tech stocks with large intangible assets like intellectual property, data, and brand equity. The market is paying a premium for Meta's future prospects. The PEG ratio, price/earnings to growth, is another important metric. For Meta, it hovers around 1.4 to 1.8. A peg below 1 typically indicates undervaluation, while one above 2 could suggest overvaluation. Meta's peg shows that it's reasonably valued given its growth trajectory. It's not a bargain bin stock, but it's also not priced to perfection, leaving room for upside. Now, let's discuss beta, a measure of volatility. Meta's beta stands around 1.2 to 1.4, meaning the stock tends to move slightly more than the overall market. For growth investors, that's acceptable. Some volatility is a trade-off for high returns. The 52-week high/low paints a picture of recent investor sentiment. Meta has seen its stock price nearly double off its lows in late 2022, as investor confidence returned amid improving ad sales and stronger earnings. This price action suggests resilience and a strong recovery from earlier headwinds like Apple's privacy changes and slowing user growth in developed markets. From a personal standpoint, I see Meta as a company that's constantly evolving. It's no longer just about Facebook. It's about the broader Meta ecosystem, where AI-driven discovery, VR innovation, and platform synergy are taking center stage. The company has been smart in responding to challenges. It's cut costs, focused resources, and doubled down on its strengths. Still, risks remain. Regulatory scrutiny is ever present, especially regarding privacy, antitrust, and political content. Competition from TikTok is also fierce, especially among younger users. But Meta has one thing many rivals lack: scale, data, and the cash to adapt. Mark Zuckerberg's long-term bet on the metaverse is still early stage, but don't underestimate its potential. With tens of billions already invested and a clear vision for spatial computing, Meta could redefine the way we interact with the digital world. If even part of that vision materializes, the upside could be massive. If you're an investor seeking a blend of growth, profitability, and innovation, Meta deserves serious consideration. The fundamental metrics show a profitable, mature company with room to grow. Financial health is rock solid, with low debt and high cash reserves. Growth metrics remain strong, valuation is reasonable, and performance indicators suggest stability with upside potential. In short, Meta is no longer a speculative bet, it's a technology titan still playing offense. Whether you're a long-term investor or a swing trader, Meta provides multiple pathways for value creation. Just remember, this is a stock that moves with the future. If you believe in the rise of AI, virtual reality, and digital platforms, then Meta might just be your best chance to invest in that vision, while also reaping the rewards of a company that's already dominating the present.